What's up, Degens? Degenninja here. Today we're just going to dive into the ETH merger and what it entails. So basically we'll go into the tokenomics, what's involved with the merge, and also fundamental analysis going forward into pricing models to evaluate ETH's current price versus its intrinsic value price. So without further ado, we'll get straight into it. So ETH merger. So basically recently the Ethereum Foundation has clarified the confusion around ETH 2.0. So they came out in a statement on Twitter and also in the official social media outlets where they defined ETH 2.0 as two separate factions to their to that layout. So ETH1 being the execution layer and ETH2 being the consensus layer. So it's not actually ETH 2.0 isn't actually a different thing to Ethereum itself. It's just an upgrade of the actual existing decentralized network. So ETH has three layers. Execution layer, consensus layer, and a data availability layer. Now, this particular ETH merge that's upcoming in about 80 days is the consensus layer upgrade. So basically, in the consensus layer, the main changes involve from proof of work. So miners doing the work to proof of stake. So delegator nodes running at the Ethereum blockchain network. So to avoid the confusion, the actual merge when it happens won't actually involve the execution layer because the execution layer is not actually upgraded this round. So that means that the gas fees will remain unchanged as to what it is currently. So there's a lot of misconceptions around this merger being an upgrade to the execution layer when it isn't really. The execution layer isn't upgraded until much further down the track, probably the latter part of the 2 years in the upgrade timeline roadmap. So that's just a website link just for some information for you guys to read about the ETH upgrade. Now this is we've had previous upgrade roadmaps in ETH before in the past, and that was from the inception back in 2015 when ETH rolled out and then it went through various phases in the cycle of upgrades to the network, and finally in 2020 we entered the Serenity phase where ETH 1.0, the proof of work mechanism, was fully perfected. Now ETH 2.0, the proof of stake upgrades roadmap is here. So the key dates in the timeline, we've had the initial ETH deposit smart contract deployed back in 2020 in October. Then we had the December 1, 2020 Beacon chain launch. So that was when ETH 2.0 staking was introduced. And you remember when anyone that participated in the proof of stake Beacon chain lockup staking for 2 years, the initial incentive was around about 20% APR. So that is the first main step on the ETH 2.0 roadmap timeline. And then we last year in August, we had the London hard fork upgrade and the EIP 1559 introduced into the ETH mechanism. So that is the gas fees divided up into two portions, one portion being the base fee and the other portion being the tips. So the base fee equivalent has been burnt every time an ETH transaction is made. So that leads to more deflationary pressure on Ethereum itself in terms of its tokenomics. More recently, later last year, we had the Altair upgrade back in Q3 2021. And the upcoming merge should happen sometime between Q2 and Q3 of this year. So we're looking at sort of 2/3 into the year, sort of past probably around sometime between July to September. And that is when ETH will go from POW to POS. So the next step after that is data sharding. That will probably take place in the latter part of this year and well into next year. But the ETH gas fees problem will still remain and linger around till at least when the execution layer sharding occurs. So that will be sort of towards the end of the roadmap when that will happen. Well, because usually so that is where we are at. So currently, this is just a roadmap timeline phase again from phase 0 to completion. We are currently in step 3 at the moment, phase 1.5, where we're going from proof of work to proof of stake blockchains. And so we've had the 0 to 1, we've had the beacon chain and the smart contracts initiated. Then we had the shard chains, and now phase 2 further on, we will have more of the what we had before here, where we've got the data availability sharding and the sharding of the chains, and then finally the execution layer sharding. So that should help reduce the gas fees and ETH, and hopefully also resolve some of the congestion problems that we have in ETH DeFi at the moment. So challenges going forward for the merge. So as I said before, the execution layer is not upgraded, so hence there are little changes to high DeFi gas fees. So that won't happen. No changes will be imminent until we see execution layer sharding upgrade in the ETH 2.0 mechanism. So other challenges include the commitment of institutions to stake into ETH 2.0 for 2 years, because obviously any ETH that's staked into the beacon chain has to be locked for up to that 2 years while this ETH 2.0 upgrade is taking place. And any ETH that's staked will be earning yields but will be unavailable to be unlocked until the final upgrade is completed. Now the merge will cause some dissent amongst miners, obviously, because there will be a loss of mining income streams for miners that are on the ETH network. And once this transition happens with the merge from POW to POS, obviously any mining rigs and GPU mining for ETH will cease. So another problem or downside that we might come across is the fact that reducing block times on the ETH network can lead to a decrease in security and decentralization due to something called connection latency. Now, for the scope of this video, I won't be covering that right now, but please, if you guys are interested in it, I'll leave a link down below somewhere, or you can Google connection latency on Twitter. And so Vitalik Buterin did mention this point in some of his past talks. And also another challenge to the merge is obviously running a validator node requires 32 ETH staked to the ETH network to run a node. And so that's a fairly high entry for most common people. Now, ETH merger tokenomics. So post merge, there will be a 90% reduction in ETH being issued into supply. Now, that's because from the POW switch to the POS proof of stake. Currently pre-merge, every year, currently approximately 5.4 million ETH is mined every year. So that equates to 15,000 ETH per day. Now, post-merge, that will decrease to 500,000 ETH per year that will be issued. And so that equates to 1.5K ETH per day. So based on those stats, we will be going from roughly current inflation year on year of roughly 4.3% in ETH to 0.43% of an increase in inflation year on year after the merge. Now, taking into account Bitcoin's inflation rate, which is roughly about 1.7%, post-merge ETH 2.0 equal to triple Bitcoin halving. And the reason for that term is because ETH issuing will occur at 4 times lower rate than Bitcoin. So that makes it more deflationary in terms of this tokenomics, as opposed to the pre-merge tokenomics, which is what it is right now. And it's slightly inflationary at 4.3%. Also with the tokenomics, obviously EIP 1559, the base gas fee component is burnt. And so every year, roughly about 1 million ETH is burnt per year. And so that is being taken out of circulation and supply, obviously. So based on the post-merge supply statistics of 0.5 million ETH released per year, supplied per year, that equates to a deflationary deficit of 0.5 million ETH per year. So that means that the deflation rate of ETH will become 0.5%, accounting for EIP 1559, and hence it's known as ultrasound money. So when ETH supply is down in the future, if the DeFi demand is constant or increasing, so basic demand supply economics will tell us that that will imply or lead to ETH price going up in the future. So currently Glassnode's data is showing that approximately 180,000 ETH is being withdrawn or taken off exchanges daily from centralized exchanges, and ETH exchanges liquidity is lowest since August 2018. So that is the in the midst of the bear market back in 2018, where ETH had the lowest supplies out in the market. So that's telling us that decreasing ETH supply will lead to increased ETH demand as well, and that is also a driver for ETH being bullish in the long term. So investors are doing one of the 3 things. The first being self-custody, so storing ETH in a cold wallet or in a hot wallet. And the second thing they're doing is using it for DeFi. So obviously you can see from the stats on DeFi Llama that ETH TVL is increasing at a rapid pace. And the third thing is the ETH 2.0 that is locked in the staking beacon chain contract. So approximately 10.6 million ETH is currently locked in ETH 2.0 lock staking. So all that ETH is not being able to be released into the market since it's locked up. And so that has helped keep the ETH supplies low in terms of liquidity. So the post-merge demand will be up, obviously, and a consequence of that will be the ETH staking rewards will also ramp up. Now, ETH 2.0 adopts a variable staking yield, and it has been steadily declining since its inception back in December 2020. It started off roughly around 20, just over 20%, and it's steadily been declining down to about 4 to 5% currently, APR. So pre-ETH 2.0 unlock, the rate currently now on the Beacon chain staking is around 4 to 5%. Post-merge ETH 2.0 unlock, we're looking at roughly around 9 to 12% variable APR. We'll go into the fundamental analysis of ETH now. And that's how to calculate its intrinsic value or valuate a crypto coin using traditional financial instruments or statistical models. So one of those things is NPV, which is net present value. And so that is a price at which rational investors are willing to pay for an underlying yielding asset. Basically, to the right here on the slides, that's a basic formula for calculating an asset's price relative to its initial price times the staking reward yield post-merge divided by the rate of return. The statisticians at the ETH Foundation have done some calculations and came up with 3 different scenarios. Obviously, scenario 1, where it says 9.46 million ETH staked in the contract, that has already been surpassed, because currently in the Beacon Chain smart contract, there's more than that. It's currently about 10.6 million, so we can discard that scenario. So scenario 2 and 3 basically is saying post-merge, we're looking at roughly an estimate of about 11.83 million ETH staked. And scenario 3 being approximately 3 months after the merge, we're looking at roughly around 14.2 ETH staked into ETH network. So that's just a rough estimate done by some statisticians. So based on scenario 2 and 3, that will give us APR of roughly between 10.2% and slowly declining to roughly 8.9% based on those statistical models. The changes in staking amount of crypto over time is instantaneous, and the differential rate is changing at a rapid pace, and it's not linear. So we actually have to use a more accurate model to account for that variability and growth. So what we do is we use a discounted cash flow analysis. So that's a model formula basically accounting for variable growth changes of yields over a period of time from when it goes from a growth to a stable phase period. So to the left there on the bottom of the left of the screen, that is the revised formula for calculating this DCF, discounted cash flow. And so it employs a 2-dividend model, which institutions often use to evaluate equities in traditional stock markets. Initial price. This ETH Foundation statisticians have used an average of $3,000 for ETH, just taking an average price over the course of this year. S1 is the initial staking yield post-merge, which is the 10.2% you saw in the table in the previous slide. S2 is the long-term staking yield. So once it goes from growth phase to maturity phase or stable phase, obviously the staking yield will drop. And based on the table in the previous slide, that's 8.9%. R is the required rate of return, and that's 4.82%, determined by the statisticians. G is the long-term growth rate of ETH, and based on the previous tokenomics that we discussed earlier, it is actually a deflationary rate. So it's actually negative 0.5%. So N is the period over which the initial staking rewards are paid. And we've determined that as 3 months, and that is between the S1 and S2 periods. So based on those calculations, we input it into that complicated formula, and on the slide here, we get the number approximate estimate price of ETH at roughly around 5,000, just over 5,000 US dollars, and anything from about 5 to 5.5K intrinsic value if no fall and long-term staking yields rate. So there are downsides to the DCF valuation model, because obviously I talked before about it assuming that it's linear changes in staking rates, whereas it's quite instantaneous and not linear. The actual rates of staking and also the input and the output or withdrawals is irregular. So the formula doesn't take into account that factor. And it doesn't account for sudden injections of funds or withdrawals of funds due to sudden blue moon events like a Black Monday or Black Friday type event where crypto could crash or moon. So that would cause like a traditional, like a TradFi sharp VIX index type volatility spike in the traditional stock markets indicator. So that doesn't take that into account. But using NPV, net present value, and also this 2 dividend factor DCF model, we get a clear verdict that ETH is still significantly and intrinsically undervalued based on our statistical models. And why is that important? It's because institutions would use similar valuation tools to do their fundamental analysis of cryptos as they do with stocks and bonds and other financial instruments or assets. So they will also come to the conclusion that ETH is significantly undervalued too. But right now, I think the reason why some institutions have held back on adopting more Bitcoin and Ethereum, particularly Ethereum, is because they want to be on the sidelines to observe how this ETH 2.0 upgrade will come about, to be sure and be more confident of their investments in something like ETH, which is a fairly volatile financial asset, especially compared to like other tech stocks or traditional finance stock markets. So that is basically it in terms of intrinsic value and fundamental analysis. So fair value for ETH post merge is roughly around 5 to 5.5 grand, and right now, fellas, it's a bargain because it's under 3K. With this current dip in recent days, anything under 3K I have been layering in, dollar cost averaging in to my ETH long-term positions, and also my shorter-term swing trades. I feel confident in terms of technically on the charts as well that it has fallen to Fibonacci zones in the daily charts. So there's a big chance of crypto rebounding right after Easter weekend. I think we might see a retest of the lows or possibly a lower low during the low liquidity period over the Easter holidays. Obviously, because everyone's on holiday, there'll be light trading volumes. And so the lack of liquidity could cause the markets to go lower. But that is it really. So the verdict, basically, anything ETH under 3K is a steal. Obviously, if you've got ETH up once upon a time, then that's good for us too. with us degens being in the space for a long time in the crypto space, we have been stacking heaps of ETH since the days of the bear market, really. And so we have seen those exponential gains since the lows of COVID and also the 2018 bear bottoms. So this year with the rate hikes, I see ETH being more or less trading in a side range, oscillating in a tight range. There might be a test of lows and year lows later this year with inflationary pressures and also financial markets, that is stocks, retracing hard, and with crypto performing similar to tech stocks. The macro investment sentiment is more bearish, but because with the unique tokenomics and this ETH 2.0 upgrade, I see big things for ETH. So I don't see it crashing like in a straight tank bear cycle like we had in 2018. It'll be a sideways market because DeFi and also NFT demand for ETH is also a contributing factor to ETH not dropping a lot. And so that along with layer twos like Loopring and Wormhole and Polygon and also Arbitrum, things like that, the layer 2 solutions have really helped smoothen some of ETH's gas fee problems partially, and also the congestion around the traffic on layer 1. So all the layer 2 protocols have really helped, and also as a result piggybacked on ETH's woes to actually mature and become big market caps in the crypto space. So that's all from me, Degenninja. I hope you liked the show today. Hope it has been helpful and insightful for you guys as a breakdown into the intrinsic value of ETH and the fundamentals behind the ETH Merge upgrade, and also clear up some of the confusion around the what it actually entails. So if you like the content, please like, share, and subscribe. That will go a long way into helping the algos bring this video to other players like yourselves. So that's all from me today, Degenninja. May Satoshi be with you, and I will see you guys in the next episode. Peace out. Adios.